Mid-caps come under pressure as stocks edge lower amid continued uncertainty over Trump's tariff moves. Telecom, industrials and consumer durables are the big drags today.
Bharti Group Arm sells close to 0.8% stake in Bharti Airtel for nearly 8,500 crore rupees via block deals. Marquee investors pick up stake along with Bharti Singtel's JV, Bharti Telecom.
ABB beats estimates on all counts with revenues growing strongly across segments, barring process automation. Margins too expand on the back of a better pricing, cost optimization and higher services income.
BHP Chief Commercial Officer sees demand for copper in India growing at 5 times in the next 25 years and steel output rising from around 140 million tons to around 300 to 400 million tons in the coming years.
You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Nigel D'Souza. The halftime does not look particularly good for the bulls. As we speak, at the top of your screens, you can see the Nifty below that 22,850 mark, the Sensex below that 76,000 mark that it conquered yesterday. The bigger drags are actually the mid-caps. The broader markets tell you that portfolios are in pain. Over 1,700 stocks in the red for just under 500 in the green. So not looking particularly good. The street would want some sort of support come by for the markets from here on itself. Those lines tell you the story of the day. Hi, Nigel.
Hi, Mangalam. Just one thing, the PCR is moving back down to around that 0.75 odd. So that is one hope. The other factors are the FIs are net short as well. And the bulls are counting on this 22,700, 22,750 odd level that's holding out. So numerous times during the day, we are going back down towards the 22,800 marks. But that's being met with some kind of buying. So that's, the hope that, in fact, we do defend lower levels. And also the breadth of the market that Mangalam just spoke about. At the start of trade, we had 1,000 stocks that were advancing. That number's come down to around 400 stocks. So you'll want that number to get a little bit better, and you'll want, both those two lines to come a little closer to each other. So we'll keep an eye out on that as well. But plenty of stocks are moving around. So let's get to a couple of them. One is Zen Technologies. Yesterday, it was down close to around 20%. Today as well, it is down close to around 10%. We had the management who joined us earlier today. Upasana joins us to help us out with a quick analysis on that. Upasana?
Well, the stock is down about 30% in the last 2 days after company reported its Q3 FY25 numbers. Now, company's growth lowered this quarter as compared to the past quarters, and it also missed the street estimates. Now, we spoke to the management earlier this morning, and here are some of the important highlights given by the management. Well, company says that it has no plans to buy shares from the open market, and it sticks to its FY25 guidance of 900 crore revenue and EBITDA margin of 35% for FY25. It has also guided that the top line will be growing at a 50% CAGR for the next 3 years, and margins, which were the key concern, management has clarified that the margins saw a dip of nearly about 1,400 bips in Q3. This was mainly because of the product mix of the company. It has also emphasized that 800 crore order will be finalized by Q1 FY26. Please listen in.
Diluted, the dilution has been mostly done because of the QIP that we did. We did sell, we did sell 4% of our stake, on 2 occasions. But the dilution has mostly been because we raised the money for acquisitions and working capital needs. I don't think we will be entering the market to buy it. Because the intention was not to trade sell high and buy low. The intention was we wanted to have some money on the table. With respect to by 27, I think it should at least double. The revenue should at least double for ARI. That's our expectation. And margin, I think it should get to the margin of 35 EBITDA and 25 net. Even though now it's around 13-14%, we expect that to ramp up, especially when we go with our value addition. Diluted, the dilution has been mostly done because of the QIP that we did. We did sell, we did sell 4% of our stake, on 2 occasions. But the dilution has mostly been because we raised the money for acquisitions and working capital needs. I don't think we will be entering the market to buy it. Because the intention was not to trade sell high and buy low. The intention was we wanted to have some money on the table. With respect to by 27, I think it should at least double. The revenue should at least double for ARI. That's our expectation. And margin, no, I think it should get to the margin of 35 EBITDA and 25 net. Even though now it's around 13-14%, we expect that to ramp up, especially when we go with our value addition.
All right, that was our Insight Edge segment. The street not particularly happy with the fact that the promoters have said that despite a big correction in the stock of Zentech, they won't be going ahead and buying from the open market. Though there is a smidge of a recovery that we've seen from 10% lower circuit, the stock has now recovered a bit and currently sitting with a cut of almost 6%, but from the peak, it has seen a near 70-75% correction itself. Speaking about corrections, look at M&M. It is a very volatile stock, and now at the low point of trade yesterday, it gave us an update onto their ESUV business. Over 30,000 registrations made for their BEL XUV. The stock opened mildly in the green today, and that has been sold into currently at the low point of trade after a 4.5% recovery, 4.5% cut rather in yesterday's trading session too. In the first half of trade, we had some support coming in from the IT pack. Now look at TCS. TCS has moved to the low point of trade, and you pull up that with the IT index itself, and that tells you that that recovery in the IT pack has been sold into as well. The IT index, while mildly in the green, is significantly off highs at the lower end of today's trading range. But one stock which is on our radar is MGL, reacting to a news update coming in from BMC this morning. Sudarshan.
So MGL has made a sharp recovery from intraday low, now up around, stock is up around 1.5%, but from lows, if you see, it's up around 3%. And it's after the news came out that BMC, that is Mumbai Municipal Corporation, has issued direction to roadside vendors, eateries, dhabas to shift to eco-friendly or say clean fuel, and the deadline is given of July 8, and it's come on the back of the recent Bombay High Court order, which had instructed BMC to ensure that these vendors shift to clean fuel very soon. And now BMC has come out with the directions. What does BMC says? It says officials are assigned to ensure transition to cleaner fuel alternatives. Else, licenses will be marked as not to renew until this transition is completed, and no new licenses will be issued to establishments using conventional fuels after July 8. And the news is positive for MGL, considering it's the biggest player for both CNG and PNG as far as Mumbai is concerned, and that's the reason you are seeing the stock is off lows.
Okay, all right. Thanks a lot for that, Sudarshan. Well, time to slip into a short break. On the other side, we'll get chatting with Sachitanand Udekar of Trade Bulls. Stay with us.
Welcome back. Perfect time to look at the F&O setup of the day. The Nifty now down 100 points. The Nifty Bank also low by about 0.5%. So the indices, they continue to fall. Mid-cap index is actually the one which has taken the biggest knock, down about 1.2%. What's interesting is that we've been talking about the market recovering from lower levels, but over the last few trading sessions, the highs have also been sold into. So if you look at Feb 13 high of 23,235, thereafter the next day 23,133. Yesterday's high was 22,974. Today's high just a little above that. From there, we've seen a big drop as well. So those are a couple of things we'll keep an eye out on. The pain in your portfolio visible on this chart out here as well. More stocks declining, way more stocks declining than the number of stocks which are advancing. A lot of short positions being added in a couple of names. ABB India, the results were an all-round beat, but thereafter, the stocks, after holding in the green, maybe some commentary coming in from the management in the conference call or, in the interview, we have seen that stock lower from those highs, seeing some fresh short positions being added. MCX and ACC are the others which stand out. Because the Nifty has been making slightly lower highs as well, the 22,900 call writers have come back into fray. So we have 110 rupees in terms of premium for 22,900, telling you closer to 23,000 supply continues to be there. Whereas the put writers at 22,800 may be unwinding their positions, and there's some punt buying at the 22,500 put. Well, it may not be the case that the market goes to 22,500 if it sees support around that 22,700 odd mark itself. But were it to break, there are punt positions being bought at 22,500 for 24 rupees a pop itself. A couple of stocks on my radar from an F&O standpoint. Hindustan Copper, it's midday itself. The open interest threshold has moved towards 92% as against the MWPL. Typically, when the stock crosses that 95% mark, enters F&O band. So keep an eye out on Hindustan Copper. The other one is Deepak Nitrite. Has been in F&O band for a couple of trading sessions. Maybe the stock exits F&O band today. So that's something that we will most definitely keep an eye out on. With that, yes.
All right, Mangalam, thanks for that. Well, let's get straight to Sachidanand Utekar, the AVP Technical Equity Trade Bulls, who joins us on the show. Sachi, how are you feeling? What do you think? This bottom's going to hold, or are we going to break it?
Good afternoon, Nigel. Good afternoon, Mangalam. I think clearly, the verdict is on the bearish side. If you look at the last 10 trading sessions, despite of the intraday moves, Nifty is not able to sustain or, display a closing above its 5-day exponential moving average. Even if you look at the, data here, I think 22,800 looks very fragile. We are of the opinion that probably we may see the Nifty breaking this particular support and sliding further towards 22,500. So we have recommended, short positions to our clients. I think the only relief would be seen in case the Nifty starts trending above that 20,040 mark. We need a decisive close above this particular level to really, kickstart that short covering move. But if you look at last 10 trading sessions, both the Nifty and the Nifty Bank are trending comfortably below their 5-day exponential moving average. So I think the short-term trend is clearly negative. And we may see that 22,800 support would be breached during this particular series itself.
Got it. All right. So 23,040, right, on the upside. That's the important mark.
Yes, Nigel. I think that is a decisive level wherein some short covering relief may unfold. But as of now, I think the data is supporting that near to that particular level, it is better to create fresh short positions.
Got it. All right. Give us some stocks as well. Trading ideas?
M&M has started declining, and if you look at the breakdown, it has been decisive at 2,900, and since then the move has been amplifying on the lower side. Even right now, it looks like the stock is headed towards its 50-week exponential moving average support, which is placed somewhere close to around 2,700. But if you look at the overall pattern on the weekly scale, it looks like a broadening structure with a base placed somewhere close to around 2,630. So I think there is a good amount of room on the lower side. Hence, we are recommending building fresh short positions in M&M. The stop loss for the trade can be placed at 28.25 on a closing basis, an immediate move towards 2,700, followed by a move towards 2,630. And on the long side, Berger Paint has been displaying a good relative strength since the beginning of the series. 480 has been a very strong support. If you look at last 4 weeks of consolidation, this consolidation now looks mature for a breakout. So we may see a bullish move towards the end of this particular expiry. We are expecting a swing towards 510, 515, where its 200-day exponential moving average is placed. And hence, we are recommending building long positions in Berger Paints. One can keep a stop loss at around 480 on a closing basis.
All right, Berger Paints this time around, the volume growth was also a lot better than everyone else in the industry, at least the listed space. Just one question, Sachi, before we let you go, on Kalyan Jewellers. The stock had seen, seemed to arrest its decline after its third quarter results, where we saw a big move on the way up after a sharp fall. But now as we speak, the sell-off has begun once again. The stock is once again below that 500 mark, closer to that 480 rupees mark on Kalyan Jewellers. Has seen a big cut from the highs. It's down about 5% and very close to its lows as well, the earlier lows that it hit.
Well, I think the major trend is still weak. We don't see any relief rally here. Probably the one which we had seen so far from 450 to 500, 550, that particular rally is also arrested. The stock is now comfortably trending below its 200-day exponential moving average plus its 20-day exponential moving average. So I think the overall major trend still remains weak. We may see the stock again sliding towards that 400 mark. So it's better to use these rallies to exit long positions. there's a good chance that the stock may continue to slide further towards 400.
All right, it'll be very interesting to see where it goes. If it stays below this mark for a very long time, maybe the promoters will have to offer some of their more shares for pledge as well. Sachi, thank you for joining in. And as we slip into a short break, let's get you some good news coming for our viewers here. You have the CNBC-TV18 app, the India Business News Leader app is now just a click away on both Android as well as iOS, where you get instant access to breaking news, in-depth articles, and financial world updates, all of that at your fingertips. What you can do is download the app now from the App Store or Google Play Store. Or if you can't do that, then just hold on for a bit. You will get the QR code right up for you on the screen. Once you get that, just put on your phone cameras, scan that for a bit, and you will be redirected to a link that takes you to the CNBC TV18 app. All the business world updates at your fingertips.
Well, let's focus on the life insurance space. And life insurers have seen good growth in embedded value over the past few years. But despite a rise in market capitalization, the sector has seen a de-rating in valuations over the past few years. Yash joins us to help us out with a quick analysis on that. Yash, take it away.
Well, Nigel, through these few numbers from the last about 4.5 years tied up, what we've tried to demonstrate is how the embedded value for life insurance companies have grown. What has been the kind of growth when it comes to the market capitalization, and how a function of these two, that is price to embedded value, reacted to that growth in embedded value as well as market capitalization. Let's start with embedded value itself. The embedded value for life insurance industry has grown between 8 to 23% over the last 4.5 years. This is, of course, compounded in that period. And as far as that period itself is concerned, FY20 to FY25, HDFC Life was the company which saw the strongest growth in its embedded value, growing at a CAGR of about 23%, followed by Max Financial at 21%, followed by ICICI Prudential Life and SBI Life at 16.6% and 16%. LIC being the slowest in terms of embedded value growth at about 8.4%. On the other hand, when compounded over the last 1.5 years, the market cap growth has been strongest for LIC. That has grown at about 53%, as I said, compounded over the last 1.5 years. Now, when you look at the last 4.5 years, Max Financial's market cap, that grew at a CAGR of 36%, followed by SBI Life at 27%, then ICICI Prudential Life at about 19% and HDFC Life at 13%. Now, we spoke about the embedded value, we spoke about the market cap growth. A function of these two is how life insurance companies get really valued, that is through price to embedded value. Now, here's the big question. With the strong growth in the embedded value for life insurance companies, have the multiples responded in a similar fashion? The answer is an emphatic no. Look at how the price to embedded value multiple has moved between FY21 to FY26, which are estimated figures. The biggest derating has come for HDFC Life from about 4.8 times in FY21 to about 2.1 times for FY26 estimates. This despite HDFC Life witnessing the strongest growth in its embedded value. The embedded value for all listed life insurance companies have gotten derated. If valuations are supportive, then what is really coming in the way of the multiples which these life insurance companies are getting? Analysts point out that the biggest reason has been the fear of regulatory intervention, either from the government or the regulator. We saw that coming in the form of taxation. We saw that coming in the form of surrender value regulations as well. The second reason has been how the product mix for these various life insurance companies has turned very ULIP heavy, which has led to a significant deterioration when it comes to the margins. Finally, the problem has also been the Indian insurance market, which is not growing. The penetration, the density for a long time has remained stagnant, and out of that market also, unlisted players are taking a lot of market share away, which is again posing a risk for these listed life insurance companies.
Take that point, Yash. Thank you. Well explained. With that, we'll step into a short break. On the other side, we'll connect with Ankit Haku, who's the director at CRISIL Ratings, to focus on India's solar cell sector. Stay tuned.
Welcome back. Well, let's focus on India's solar cells sector. We have CRISIL in recent reports said that the solar cell capacity is expected to go up by 5 times to around 50 gigawatt by FY27. The capacity is aided by government's policy thrust to reduce imports of cells as well as modules. To help us out with a quick analysis on that, we have Mr. Ankit Haku, the director at CRISIL Ratings, who joins us on the show. Hi, Ankit. Good day and thanks a lot for joining in. Well, we're going through your report. First, let's get a couple of details out of the way. India is on its way to around 500 gigawatt of renewable energy. And as of now, going by the renewable capacity as of now, solar is roughly around 30%. So by 2030, do you see that, solar should be approximately 160, 170 gigawatt or thereabouts? Should that be the fair estimate?
Yeah, that should be a fair estimate, Nigel. Okay. Considering that 500 gigawatt is an overall number, but pure solar and wind would be actually lower. There are other forms of clean energy which also constitute a part of this 500 gigawatt.
So solar should be approximately 30% of that mix, right?
Yeah, roughly that, Nigel.
Okay, all right. Now let's focus on a couple of aspects. To get solar plants, you require modules as well as cells. Could you give us an updated number? Currently, what is the total module requirement? What is the cell requirement? And how much of both these two are made domestically and how much is imported? Please go ahead.
Yeah, sure. See, if we take that nearly 19 gigawatt of renewable capacity was executed in fiscal 24, and you may say that nearly 17 odd gigawatt of that 19 gigawatt was solar. So that 17 gigawatt is what is the overall module demand. And earlier, the modules were largely sourced from China, and a limited proportion was actually manufactured domestically. But that proportion has now grown, and nearly, if whatever research says, is that nearly 60-70% of the overall demand of modules can be actually manufactured here in the country. Similarly, if 18 odd gigawatt is the overall module demand, that is also the cell demand per se. But at the moment, the indigenous capacity of the cells is quite low, and a lot of it is actually imported from China. I think that is where the endeavor is, to ramp up the cell capacity, so that just like modules, we are also able to manufacture cell within the country. Right now,
how much of solar modules and cells are imported right now? How much of it is served domestically in terms of percentage?
So almost, if I have to say, almost all of it would be imported from China at the moment, because there is hardly any cell capacity. You will find some cell capacity which is there, but you may say that nearly 10% of the overall cell requirement would be there within the country, and a lot of it is actually coming from outside. It is actually assembled into modules, and then modules are being sold within the country.
Okay, all right. We have a few players from the listed point of view, but that aside, some of them are talking about having module capacity, and now they're getting backward integration. That is, they're putting up cell capacity as well. A couple of names, Premier, Vare as well, they have been talking about that. But we wanted to understand from you, what could the potential savings be? If you're backward integrated, then what is the cost? How much do you save on the cost aspect?
So I'll talk about the manufacturers here, because for the developers, it's slightly a different story. But for manufacturers, if you're just assembling, if you're just assembling cells into modules, vis-a-vis you are manufacturing cells from wafers and converting into modules, there is a differential of 5% on a margin that we see, including the conversion costs which are there.
Who are the companies? Right. Who are the companies that are backward integrating right now?
I think your major module manufacturers, all of those guys have shown interest as a part of the PLI scheme to integrate into cells as well. So your players like players like Wari, Premier, Adani, even Reliance, all of those guys, they have actually shown interest to integrate vertically backwards.
And that would improve their margins by about 500 basis points immediately, as your research says.
So it is, yeah, so that indeed is true, but it not only is the question of the margins. You know, when you are actually growing quite fast, and in the coming years, if you have to reach the target which the government has in mind, which means that on an annual basis, the capacity additions of solar, which you saw in fiscal 24, say 19-18 gigawatt, that should ramp up to over 25, close to 30 gigawatt, and even further going years ahead. You want security on your supply chain as well. So you cannot, when you're talking about scale, when you're talking about such numbers, you want to be assured of the quality. You want to be assured of the supply. And I think that is also one of the motives for people to actually integrate backwards.
Okay, all right. We have that ALCM and ALMM that are currently protectionist measures for the industry. When does this expire? When does it come in for renewal? And what is the next trigger? I believe sometime in this year itself, there is one of them who comes up for renewal. Could you explain that to us?
So in terms of the implementation is what I can talk about. Renewal, when they expire, is something that I'll have to get back on.
Okay.
But ALMM was implemented in the previous fiscal. In fact, it was in the works for quite some time, and the deadline was extended, but it got implemented somewhere, I think, the 1st of April of the previous fiscal. ALCM is expected to come in the April of this calendar year. And yes, these are measures which will support the manufacturers, but it actually somewhere is also required if you are to compete with imports.
And the ALCM that you're talking about, that has to come into play this year.
Yes.
Do you see it getting implemented, or do you believe that there'll be a delay? And if it gets implemented, what could be the the benefit for the domestic guys?
Yeah. Whether it can, I'll take your first question first. Whether the deadline can get extended, it can only be actually it'll have to be monitored and seen whether the deadlines are indeed extended. But the second question, what are the benefits of ALCM to the manufacturers? You know, if you take cell from, if you are just importing cell and converting it into modules, vis-a-vis you are importing wafers, converting into cells and then to modules. Of course, there is an EBITDA benefit to the manufacturers. However, there is the cells that you will manufacture domestically will actually come out to be much costlier than what the imports are as of right now. So there is a differential for the players. So the point is that the manufacturers will be selling these cells at a much higher cost than what the developers can get if they import it. However, alluding to my earlier argument that if the scale is going so much and you have to protect your supply chain, you need certain protective measures for the manufacturers also. And that is where these protective measures will help these cell manufacturers in the near time when the economies of scale are yet to develop. Once the economies of scale develop, then we see that the conversion costs of cell manufacturing will also go down and will slowly they will start to become competitive. But at this point in time, they will require these protection measures just because the cell prices domestically would be very different from what you get from imports.
Yeah, quickly before we let you go, what is the current differential in prices from the imported products and the ones that are manufactured domestically?
So our understanding from the various players, the manufacturers, is that if you import cells and you manufacture it domestically, the domestically manufactured cell would somewhere be 80 to 90% costlier than the imported cells landed cost.
80 to 90%. All right, we take that point. There is an opportunity, but there is also, an expensive cost. So we'll keep an eye out on any regulatory action that takes place out there as well. Thank you so much for joining in and giving us a lowdown on this sector. We take a short break, come back, focus on the market, stock-specific action on the other side.
Very good. One of those massive words,
about Canva's startup story.
220 million people that use Canva as a product as well. They launched with 5 languages in 2016. They then ratcheted that up to 100 languages in 2017, including Hindi, Tamil. I think India could be huge, so it's our 4th biggest market at the moment. I think it could reach the #1 position, very soon. We've been able to move large parts of the company towards thinking in an AI-first manner.
Interesting.
24 million right now, so
Breaking news. The last few years have really been about the shiny objects, and 2025 is probably going to be much more about real use cases.
we've now matured our ML and our AI teams to adapt to this new technology, and we've pivoted every product team inside Canva now to think AI first.
Some kind of recovery is what you're seeing from the low point of the day, because the select stocks, they have seen some buying interest. Grasim has cut its losses into half. It's still down, but it's recovered from the day's low. Shriram Finance is another one that's seen some kind of recovery from the low point of the day. And I think L&T, the one that was down more than 0.5% an hour or so ago, that one is on the verge of moving into the green. And that's a rather large weight that we're seeing out there. In terms of a sector that's doing a relative outperformance today, tech is the name yet again. So the tech index should come up for you. You have stocks like Wipro, Infosys. They're perked up a little bit. But tech's up close to around 0.5% while the markets are struggling. I'll tell you what, we'll slip into a short break, come back, continue to focus on markets and stock-specific action. Welcome back. Well, let's take a break from the equity markets. Talk about the commodity corner then. My colleague Manisha Gupta spoke to Ragnar Ud, the Chief Commercial Officer of BHP, to discuss the global trade picture and their business outlook amidst the tariff concerns. She began by asking about the company's first half performance and where is it headed from here on. Let's listen in.
I think what you've seen through our first half year results that we've just posted is actually a company in excellent position. We are positioned well in terms of the current environment, despite the fact that we've actually seen declines in iron ore and met coal prices decreasing by about 20%. Nonetheless, you're seeing a very healthy profit result being posted and distributions to our shareholders that fall within our dividend policy, and also a fantastic growth portfolio in front of us, reflecting our strong operational performance and capital discipline as an organization.
Rag, how would you look at the tariffs that are being thrown around, splashed around all over the world? Started from US, and then we've seen some retaliation coming from China. There's a conversation with Europe as well. What is your sense? How long could this go on? Do you see some of these being pulled back, as we've seen in most cases?
We're really taking a wait-and-see approach on this at this point. So obviously there's a lot of rhetoric and positioning that's taking place on this. Nonetheless, for ourselves as an organization, we think we're well positioned in terms of what the world's needs are going to be, and also the commodities that are actually going to drive that. And for our perspective, we'll wait and see where it goes to, but overall, we think we're very well positioned as an organization.
The other important thing in the global markets to look at really is the currency volatility. And how are you reading into that? Is that impacting trade in some sense as well, or is expected to impact?
Look, volatility is a part of any business that you're a part of. And I think for ourselves as an organization, we feel we're well placed for what the world needs moving forward. So if I take a look at the geographies that we operate in, the commodities that we operate in, these are all multi-use commodities that can be used in a number of different facets, depending on where the world pivots to or shifts to. Copper is a great example. We see population growth occurring that will continue to drive the need for more copper. But in addition to that, we also see growth in copper coming forward in terms of AI and data centers and increasing expectations on that, and decarbonization continuing to be a focus that will need more copper as well. Now, we recognize that there will be ebbs and flows in any one of those demand signals over time, but that's part of being a a company like ourselves that actually has a really solid strategy focused on those commodities.
Like, how are you looking at various geographies, as you spoke about, especially Asia and specifically India? How does that look in your whole scheme of things?
Really exciting prospects in Asia and India more specifically. What an exciting country. If I take a look at what's taking place in India, already the world's largest country with global GDP growth or GDP growth of over 6%, with a budget that's actually, I would actually characterize it not so much as a budget, but more a vision in terms of where India is going to. And when we think about the commodities we produce, whether that's in iron ore, where we see steel production in India potentially increasing from 140 million tons to a clear path to 300 million tons and maybe 400 million tons. This is something that we're well equipped to actually provide the raw commodities needed for that steel growth. We see copper growth in India growing 5-fold over the next 25 years as demand for more traditional uses, data centers, and decarbonization comes forward. And even in potash, we know that the world is actually going to need more fertilizers to bring more food to the world. And this is something that we're specializing at and have some of the best deposits in the world to actually meet those needs.
If you look at 2024, Rag, it wasn't such a great year for metals. We did see highs, but we didn't close the same way. 2025 has begun on a stronger note as well, but the concerns about Chinese demand just about continue. Most people now tend to say that China will perhaps never ever go back to the kind of growth rate or numbers that we saw. But with the stimulus measures, expectations, tariffs ongoing, what's your sense from Chinese markets coming now?
Look, we're probably have a more of a strong view in terms of where China's going to. And you're right, the GDP growth rates in China have decreased from the 8% we saw a decade ago. But still, 4 to 5% GDP growth on the scale and size of China at the moment, that is unbelievable growth moving forward. Now, for ourselves, when we look at China, we still see steel production sitting at over 1 billion tons a year. 6th year in a row that they actually delivered that in calendar year 24. We expect to see that in the next couple of years as well. In terms of copper, there's an insatiable demand for copper concentrates in China and growing demand for copper cathodes as well. So while, yes, there have been some down signals in terms of housing, we think we've actually hit the bottom on the housing market. And in addition to that, the Chinese economy has been so resilient in terms of pivoting their steel use from housing into manufacturing, decarbonization products, and a whole host of other areas to keep that country moving forward. I expect that we'll continue to see stimulus measures take place, but I think that'll be in response and in reaction to some of those tariffs that you actually mentioned, if they take place or not. But one way or the other, we think China's probably best positioned to actually weather tariffs.
I want to talk about specific commodities now, and I'll start with copper, where we are looking at COMEX and LME price gap now standing at a 10%. Tariff concerns yet again. But what is your sense on demand going forward globally, and what is the price range that you are putting for copper for this year?
So copper demand is, we're expecting a 70% increase in copper demand between now and 2050. And the reason being, as I mentioned, those 3 pillars, whether it's traditional growth, data centers and AI, and decarbonization, all of those actually are providing signals that copper will actually be quite an exciting commodity to be a part of in the foreseeable future. When I come back specifically to BHP, that's why you've seen a 24% increase in copper production over the last 3 years, which positions BHP as the world's largest copper producer. And in addition to that, the growth pipeline we've got in front of us in Chile, South Australia, Argentina, and potentially the United States as well, we think that actually sets us up very well for the future and is bang on strategy, rock solid performance in terms of our operations, and this sets us up well for the future.
And you as a company, you seem pretty excited about potash. You forayed into that in a big way, and food clearly is a big market right now. Where do you stand on that, and what are the plans therein?
We see potash as a tremendously important commodity for the world, and the reason being is that we know that fertilizers are going to be indispensable as the world's population continues to increase. We're forecasting that the world's population will increase from 8 billion to about 10 billion by 2050, and that's going to require basically high-quality fertilizers to actually bring forward the crops and nutrients necessary with less arable land than in the past. Now, when we look at our deposit in Saskatchewan, this is a Tier 1 basin that we've actually developed with a lot of our expertise. It's the first new underground potash mine in that region in 30 years, which is enabling us to bring forward cutting edge and new technologies that others just won't be able to repeat based on the investments that are necessary up front. And we think this sets us up very well starting in 2026 when we get into production.
Rag, talk to us about overall commodities as a space as well, with so much happening in the background, whether it's about uncertainties with tariff, interest rates, currencies, geopolitics as well. How are you looking at overall commodities as a sector going forward, especially for this year?
Well, it's a really interesting point. And so as an organization, you've got to make decisions about what commodities you enter into and what you don't. And that's when you think about investments with BHP, you need to be thinking about what's the strategy and the long-term decisions that you've actually taken. And for ourselves as an organization, we've been very deliberate in actually maintaining our focus on bulk materials like iron ore and metallurgical coal, making sure those portfolios are right-sized for the future, but then actually segmenting our growth into copper and into potash, which we think have multi-use, multi-geographies, multi-customers, and we think that that will allow us to actually not only survive, but thrive in the environment that's in front of us in terms of this volatility and uncertainty.